Let me tell you something that should matter to every American who buys groceries, fills up their gas tank, or wonders why the cost of living keeps rising. Right now, the United States is carrying out one of the most self-inflicted economic mistakes of the modern era, and most people don't even realize it's happening. It began quietly on February 1st, 2025. That was the day President Trump signed executive orders imposing sweeping tariffs on Canada. 25% on most goods, 10% on energy products. With that single decision, the United States disrupted the most integrated trade relationship in the world, not with a rival, not with an adversary, with Canada. Why this relationship matters? The United States and Canada don't just trade goods, we share supply chains. Auto parts cross the border multiple times before a single car is finished. Canadian crude oil flows into American refineries that were built specifically to process it. Steel, aluminum, lumber, food products move back and forth every day. This relationship took decades to build, and it was dismantled in weeks. What replaced it wasn't strength, it wasn't leverage, it was higher prices for American families. The myth about tariffs. Here's the part that was never explained clearly when these tariffs were announced. Tariffs are not paid by foreign countries, they are paid by American importers, and those costs are passed directly to American consumers, every dollar. According to the Budget Lab at Yale University, the Canada tariffs reduce the purchasing power of the average American household by about $1,200 in 2025. That number is expected to rise to $1,300 in 2026, according to the Tax Foundation. That makes this one of the largest effective tax increases on American households in decades, and it didn't require Congress. The gas price effect. Nowhere is this more visible than at the gas pump. Canada supplies about 60% of U.S. crude oil imports, roughly 4 million barrels per day. Much of the Midwest and Great Lakes region depends almost entirely on Canadian crude. Some refineries process fuel that is over 70% Canadian-sourced. When a 10% tariff was placed on Canadian energy, it translated directly into higher fuel costs. Analysts estimate gas prices rose 15 to 30 cents per gallon in the short term. In some northeastern states, where Canadian refined gasoline is shipped in, increases reach 20 to 25 cents per gallon. For a typical fill-up, that's an extra $3 to $6 every time. That's not abstract economics, that's a tax on getting to work. Retaliation was inevitable. Canada didn't have a choice but to respond. They imposed 25% retaliatory tariffs on American goods, expanding to over $150 billion within weeks. The targets were deliberate. Kentucky bourbon, Florida orange juice, manufactured goods from politically sensitive states. American bourbon exports to Canada collapsed 85% in one quarter. Major distilleries halted production. Jobs were cut. Florida citrus exports fell sharply, hitting an industry already under strain. This wasn't theoretical, it was immediate. Tourism and manufacturing damage. Canadians make up the largest share of international visitors to the United States. In 2025, Canadian tourism dropped sharply. The U.S. Travel Association estimates a $5.7 billion loss in tourism spending, largely from Canadians staying home. Border states felt it first. Hotels, restaurants, small businesses lost their most reliable customers. Meanwhile, manufacturers faced rising costs for steel, aluminum, and auto parts. Only about 12% of Canadian exports to the U.S. are final consumer goods. The rest are imports American companies need to build products. Tariffs didn't protect supply chains, they broke them. The strategic consequence no one is talking about. While the U.S. was escalating a trade war with its closest ally, something else happened. Canada moved on. In January 2026, Canadian Prime Minister Mark Carney stood in Beijing and announced a major trade and investment agreement with China. This was Canada's first prime ministerial visit to China in nearly a decade.
China slashed tariffs on Canadian agricultural products. Canada opened its market to Chinese electric vehicles. Joint industrial investments are now under discussion. Carney said it plainly. Canada is reducing its reliance on the U.S., not out of ideology, out of necessity. America's influence is slipping. Canada is expanding trade with Europe, Asia, and Latin America. They've redirected 25 to 30% of exports away from the U.S. in a single year. Why? Because businesses don't build their future around unpredictable partners. This is the real cost: lost influence, lost trust, lost market share. China didn't force this. The U.S. created the opening. The big picture. For 75 years, American power rested on alliances and reliability, trade agreements, mutual trust, predictable leadership. That foundation is cracking, not because America is weak, but because it is acting erratically. Tariffs on allies don't project strength, they signal instability, and other countries are responding accordingly. What happens next? If this continues, Canada will keep diversifying away from the U.S., American exporters will keep losing markets, gas prices will continue reflecting tariff costs, China will keep filling the gaps we create. This isn't collapse, it's erosion, slow, quiet, and extremely difficult to reverse. Closing. This isn't about politics, it's about math. Trade wars with allies raise prices, weaken supply chains, and push partners toward competitors. That's not winning, that's self-harm. If you've noticed higher gas prices, higher grocery bills, and greater economic uncertainty, this is part of the reason. This was a choice, and choices have consequences. If you found this analysis useful, subscribe for clear, fact-based breakdowns of what's really happening behind the headlines. Share this with someone who thinks tariffs are paid by foreign countries, and let me know in the comments, do you think this course can be reversed, or has the damage already been done? I'll see you in the next report.